Hello and welcome to Social Security 101 with Paces Ferry Wealth Advisors. My name is Zach Morris and I'm the managing partner and co-founder of Paces Ferry Wealth. And today we're going to talk a little bit about some basic Social Security strategy. We're even going to touch on a little bit of advanced strategy. So when you're talking to your friends at a dinner party and they say they know everything about Social Security, you can drop some advanced knowledge on them as well. If you have any questions, feel free to give us a call. Of course, if you're a client, call us anytime or talk to your advisor. If you're not currently working with Paces Ferry Wealth, feel free to schedule an appointment with one of the scheduling links that will pop up from time to time. And there'll also be a scheduling page that you'll be redirected to after this presentation in case you would like to schedule a meeting with us that way. So let's go ahead and jump into the presentation today. I've got a couple things that I need to mention from my compliance department, and then we will be on our way. So this presentation should be regarded as educational information on Social Security and is not intended to provide specific advice. If you have any questions regarding your particular situation, you should contact your legal or tax advisor. Also, Paces Ferry Wealth is a registered investment advisor of the Securities and Exchange Commission. So that was for my compliance department, and the rest of this presentation is for you. So today's agenda, we're going to be covering what Social Security means to you, some common questions, as well as understanding a couple of different Social Security strategies, as well as some advanced strategies. So let's talk about a little history. Meet Ida Fuller. Ida Mae Fuller received her first monthly benefit of Social Security in 1940 for a whopping amount of $22.54. So that was the first Social Security check ever received. Some early critics of Social Security when it first was announced and first came out was people that thought that the U.S. government was going to make everybody wear dog tags with their Social Security number on it. Obviously, that did not come true, but those are what the early critics thought. And then some early mistakes. One notable mistake was that a Woolworth employee's Social Security number got into a wallet promotion that went out to a number of people in 1938, and more than 40,000 people have since filed for Social Security using that number. And we have the number listed here as well. So obviously people are much more guarded with their Social Security number now with all of the potential identity theft. But when it first started, people were not so guarded. Some basic information on Social Security, because a lot of people may think, well, how important is Social Security? Why is it important to me, right? So even high income earners, Social Security makes up a large part of their retirement income. So starting on the right side of this slide, moving to the left, for high income earners, it makes up 27% of their retirement income. For medium income earners, 40%, and for low income earners, 75%. So this is a very big benefit that affects a lot of people, not just low income earners. So some of the things that we're going to talk about today are, will Social Security be there for me? How are my benefits determined? How do I decide when to collect? How do I use spousal benefits? And of course, how survivor benefits work are both very important topics that we're going to cover. So the first question is, will Social Security be there for me? This is what everybody asks. And of course, there's been a lot of information in the news lately about Social Security benefits being diminished or being cut to 70 to 80% of the actual benefit that people are entitled to. So when Social Security was first put in place, they knew that it wasn't going to last the way they structured it. So in the early 80s, the Social Security Administration got together and they came up with a new plan, a way to extend the benefits. By extending the benefits, one of the things that they changed that you may notice if you're born after the year 1954 is that they said in order to receive your full retirement age benefit or your primary insurance amount, which we'll cover those terms in a moment, you have to wait until no longer 66, but 66 and 2 months. 66 and 4 months, 66 and 6 months. So this was a way of extending the life of Social Security by making people wait a little bit longer to receive their benefit. So when they got together in the early 80s, they knew that even that fix was not going to extend it past 2034, 2035, and that they would have to get together again to make changes. So some of the things that they could do are increase Social Security tax rates. Hopefully they don't do that. Higher maximum of earnings subject to Social Security tax, which is something called the Social Security wage base. They've increased that significantly in the last few years. It was 137,000. I believe now it's closer to 160. Increase of full retirement age, similar to what they did in the early 80s. Decrease of future retirement benefits. Hopefully they're not going to do that. And then reduction of future cost of living adjustments. And we've seen in the past couple of years, those have actually increased based on inflation. So a couple of things that I want to mention is that the Social Security Administration and the chief actuary of Social Security offers the ability for anybody to submit a solution. Not only can they submit a solution, but the chief actuary will actually come up with a response. They'll come up with a response and it will include a chart typically that looks something like this. So this chart, going back to this one, this chart shows that based on this person's proposal, and it could be any congressman or woman can submit a proposal. Based on this proposal, it would extend it to past 2050. Another proposal would extend it, looks like indefinitely. So I just wanted to put these charts in here to show you some of the types of proposals. But if you go to Google and you Google proposals to extend Social Security benefits, it'll actually take you to a website that shows every proposal that's been made and then the response made by the chief actuary. So interesting information there. I think personally that Social Security will be extended. I think it's a bipartisan issue. And as you saw by how much retirement income it replaces, it affects even high income earners and many of the members of Congress. So it's in their best interest to come up with a way to extend Social Security. So next question is, how are my benefits determined? So let's get into a couple of the terms that we're going to talk about in this presentation. The first is the full retirement age. So full retirement age, as I mentioned, if you're born before 1954 is 66. If you're born after 1954, it starts to tick up by 2 months every year. 66 and 2 months, 66 and 4 months, and so on. At your full retirement age, you will be eligible for what's called your primary insurance amount, or your PIA. If you take before full retirement age, you get less than your primary insurance amount. If you take after full retirement age, you can get more than your primary insurance amount because you start to get what's called delayed retirement credits. So a couple of important terms for this presentation: full retirement age, primary insurance amount, and delayed retirement credits is what you get if you wait past your full retirement age. So how are my benefits determined? You need 40 credits for full eligibility, usually 10 years in the workforce in a full-time job. If you work a part-time job, you may not get the full amount of credits for that year. Maybe if you worked part-time for 20 years, you could get the full 40 credits, and so on. So you need to have a full-time job for the full 10 years. And it doesn't have to be all together. You could work 5 years, and then later you could go back to work and work 5 more years. So the credits only determine eligibility. They don't determine how much you get in your primary insurance amount. The PIA, or primary insurance amount, is based on your highest 35 years of working history. Now, it's based on that. It's based on that Social Security wage base, right? So if 20 years ago, the Social Security wage base was much lower. So there was a much lower hurdle to max out your Social Security. And then every year, based on inflation, it either goes up or stays the same. And the more you pay in toward that Social Security wage base, the more your benefit goes up. So sometimes people ask the question, well, if I need to keep working in order to continue to maximize my Social Security. Well, that's not necessarily the case, because if your highest earning years are behind you, then you may not actually be increasing your benefit. You may just be replacing one of those lower income earning years. And then it only relates to the individual benefits. You may still be eligible for spousal or survivor benefits, regardless of your credits earned. So that's important. Even if you don't have a working history, you still may be eligible for both survivor and spousal benefits. And we'll get more into those specific benefits later in this presentation in more detail. So how can you estimate your benefits? The best way is to go to ssa.gov/myaccount. If you haven't set up an account before, they'll ask you some security questions that you never created, because Social Security Administration knows everything about you, such as what address did you live in when you were 12 years old? So you should know the answers to all of these questions, and it will give you access to your account and also your estimated benefits. So what are your options for filing for Social Security? So you've got a couple different options. You can file early, you can file at full retirement age, or you can file much later. So if you file at full retirement age, you will receive 100% of your primary insurance amount. So as I mentioned earlier, if you are born after 1954, as you can see here, it ticks up by 2 months every year. So if you're born after 1960, your full retirement age is much later, would actually be 67. If you file early, you actually get a discount off of your primary insurance amount. So here, using the age, if your full retirement age is 67, you'd actually only receive 70% of your benefit if you filed at age 62. Now, think about this, and I'll talk about delayed retirement credits more in a second, but by waiting 1 year after your full retirement age, you get an additional 8% a year. So using 67 as the full retirement age, if you waited until 70, which is the last year that you can take Social Security, you would get a total of 24% additional added to your primary insurance amount. So 124% of your primary insurance amount. But if you took it at 62, you'd get 70% of your primary insurance amount. So 70% to 124%. That's quite a big jump, and something to take into consideration when you're trying to determine, when should I take my benefits. Now, sometimes emotions or different thought processes may lead you to take early, regardless of the financials. Sometimes people say, well, look, I've paid into Social Security my entire life. I don't care if I'm taking a lower benefit. I don't want the government to have the money any longer than they have to. That is fine, and somewhat more of an emotional decision, and no financial calculations is going to convince someone otherwise in that case. However, there are many financial reasons for waiting until at least full retirement age, and sometimes even longer. can I work and still receive benefits? So this is an important question and something that not a lot of people think about when they start to consider when to take Social Security. So before full retirement age, if you start taking Social Security and you're still working, you will get a discount or you'll get benefits withheld $1 for every $2 of earnings above a certain amount. In 2023, that amount is $21,240, and that goes up every year or stays the same depending on inflation. So if you were actually making a couple $100,000 and you filed before full retirement age, you could technically get nothing. Now, the year you reach full retirement age, that amount changes. So it's $1 benefits withheld for every $3 in earnings above $56,250. And if you file after full retirement age, you can make as much money as you want and nothing is withheld. Now, I use the term withheld and not foregone completely because it is technically withheld. However, the benefit does not come back to you in the way water flows out of a king's hose. It actually is given back to you on a pro rata basis based on your life expectancy. So it is comes back to you in a very slow format and is really not worth having that benefit withheld in order to file early and get a small benefit if you're still working. So if you wait later past full retirement age, you get what's called delayed retirement credits. So the delayed retirement credits are 8% a year, non-compounded. So think about that. If your full retirement age is 66 and you get 4 years worth of delayed retirement credits, you can get a full 32% added to your primary insurance amount, or 132% of your primary insurance amount, because it's non-compounded. So the easy calculation is you just take primary insurance amount, take 32% of that, and then add it back to your primary insurance amount. Now, if your full retirement age is 67, you have less that you can max out. You only get to add 24%, but it's still a significant benefit, adding that 8% a year by waiting. So how do I decide when to collect? So I think you have the basic knowledge to determine what your benefit might be depending on when you take. This chart shows the difference in taking it 62 versus taking it 67. So you can see this person's full retirement age is 67. If they wait until 70, they get $240 more, or 24% more than their primary insurance amount. And if they take it 62, they get 70%. So that represents a 77% increase in monthly benefits. So kind of, pick where you want to on this chart. But more times than not, it's beneficial to wait till your primary insurance amount or you're eligible for your primary insurance amount, or you get some kind of delayed retirement credits. So this shows the break-even date of waiting versus taking it at 62. Now, a lot of people focus on the break-even date, and what I'll show you in a few slides is that a lot of people don't think about the survivor benefit. So if somebody says, well, I'm not in great health, what if I wait until 70 and then, I'm no longer on this earth? I waited for that higher benefit and I wasn't able to benefit from it. Well, if you have a lower income earning spouse, you would actually be locking in that survivor benefit for your surviving spouse, because the survivor benefit is 100% of the benefit, either that you were receiving when you passed or that you were eligible for. So more on that in a little bit, but something to take into consideration when you're thinking about whether I take early or whether I wait. Some other factors to consider when thinking about when to collect: health, right? If you and your spouse are both in bad health, then maybe taking early would be beneficial. Of course, not taking before full retirement age if you still have a working history, if you still have income, earned income, that is. Passive income doesn't affect your Social Security benefit. But if you have earned income, you may actually file and receive nothing if you have too much income. Marital status, years in the workforce. If you're still working and adding into those higher income earning years, it may be beneficial to continue working and pay in and not collect Social Security. And then other retirement assets. What other sources of income do you have, and how important is it to get those delayed retirement credits for your financial plan? So, how do spousal benefits work, and how do I use spousal benefits? So some things to consider in spousal benefits are, if you file for spousal benefits at full retirement age, your spousal benefit will be equal to 50% of your spouse's primary insurance amount. So you must be 62 years or older to qualify. But if you take it at 62, you actually get a diminished spousal benefit. So just as if you were to take your own benefit at 62, you would get less than your primary insurance amount. If you were to file for your spousal benefit at 62, you would get less than 50% of your spouse's primary insurance amount. So one thing to take into consideration, and that I want to highlight here, is that if you were to wait past your full retirement age, you don't get delayed retirement credits on your spousal benefit. Also, by your spouse waiting longer, it does not increase your spousal benefit. So you cannot collect benefits on your current spouse's record until he or she files. So you can't get your spousal benefit until your spouse files for their benefit, but them waiting increases their retirement benefit, or it gets them delayed retirement credits, but it does not increase your spousal benefit. So a couple moving parts there, a couple pieces of the puzzle to consider when you're trying to figure out, when should I take, when should my spouse take? And we'll look at a case study that takes into consideration all those factors in a moment. So you'll be able to see how those moving parts work. Amount is reduced if taken before full retirement age, as I had mentioned. And these rules also apply for divorced spouse benefits as long as the marriage lasted for at least 10 years and the beneficiary spouse is currently unmarried. So something to take into consideration when you're wondering if, or you're considering getting remarried, what is the working history of the person you're about to marry look like? And for your financial plan, does it make financial sense? Or does it make financial sense just to live together and not get remarried, because you would both be better off from a financial perspective if you were to be able to tap into your ex-spouse's spousal benefit? So something to consider when looking at spousal benefits. So here's our case study. We have Frank and Ellen, both age 66 today, and both full retirement age is 66. So they were born before 1954. Frank is the higher wage earner, and Ellen is the lower wage earner. So, one moment. Okay. In this first illustration, we're going to talk about retiring at full retirement age. So they can file at full retirement age, enjoy retirement, and Frank's primary insurance amount in this illustration is $2,600 a year, and Ellen's primary insurance amount is $600. Sorry, $2,600 a month, and Ellen's is $600 a month. All right. Now, if they both file at the same time, remember that Ellen can tap into her spousal benefit if Frank files. So since they're the same age, and many times when you're close in age, it allows for more strategies. So you have a little bit more flexibility to play with the numbers. But since they're the same age, Frank files, Ellen files at the same time. Frank gets his primary insurance amount, but Ellen, instead of getting her primary insurance amount, is going to get her spousal benefit, which is half of Frank's primary insurance amount. So Ellen is going to get $1,300 and Frank's going to get $2,600. So that's going to be their monthly benefit, their combined monthly benefit. Now, when Frank passes away, Ellen's $1,300 is going to go away, and she will step up to the $2,600, which is her survivor benefit. Again, 100% of the deceased spouse's benefit at the time of their passing, or 100% of the higher benefit between the two. So here's the timeline, and this is how it looks. So they both file at full retirement age. Frank gets $2,600, Ellen gets $1,300. Frank passes away much later on, and Ellen's benefit moves up to that $2,600. So that's if they both file at full retirement age. Now, the next illustration is, let's see how we can maximize the survivor benefit and really maximize benefits altogether. So in this illustration, Frank is going to delay his claiming until 70. So he's going to get 4 years of delayed retirement credits. All right, so he'll get his maximum monthly benefit. Ellen is going to claim her own benefit at full retirement age. So I'm going to repeat that. So in the last illustration, Ellen filed and got her spousal benefit. So she got $1,300. But in this illustration, she's going to file at her full retirement age, but Frank didn't file yet. So Ellen is going to be eligible for her benefit because she also has a working history. So she will get $600 until Frank files. So once Frank files for his benefit, Ellen will switch to her spousal benefit. So this is how this looks. Ellen files at full retirement age, gets $600 a month until Frank files. When Frank files, Ellen jumps up to her spousal benefit and gets $1,300 a month. When Frank files, he's actually getting no longer $2,600, he's getting $3,432 a month. So $3,432 plus Ellen is switching to her spousal benefit at $1,300. So you can see they're really maximizing their benefit here. And when Frank passes away, Ellen moves up to the $3,432. So that shows how he's really maximizing the survivor benefit for Ellen in this illustration. So this chart shows there's a lot going on here, but what I want to really point out is in the event that Frank only lives to 75. So this blue bar here, if they both collect at 70, even though Frank only lived till 75, they still have more of a lifetime benefit than if they were to collect at 62 or even collect at 66. And the reason why is because Ellen lived till 93, right? So she collected that survivor benefit, that higher surviving benefit, and was really able to maximize her lifetime income from Social Security. So something to think about, and what a lot of people don't think about when they look at those delayed retirement credits is not only just when's my break even, but what is the survivor benefit for my spouse? So if my surviving spouse or future surviving spouse is in good health and might live to 100, then that's something to take into consideration. And going back to the slide of considerations to make, one of them is certainly health when looking at when to take your benefits. So how do survivor benefits work? Couple of things to consider when looking at survivor benefits. Again, we mentioned the surviving spouse receives 100% of the deceased spouse's benefit, except in the case of accident. Now, this is a unique knowledge piece here that not a lot of people know. So except in the case of accident, a couple must be married for at least 9 months at the time of death in order to receive survivor benefits. Now, jumping off course here to spousal benefits, because this is a unique thing about spousal benefits as well. You have to be married for at least 1 year before you can receive spousal benefits. So something to keep into consideration there. So survivor benefits gets the full benefit at full retirement age, but they must be at least 60. So I want to say this again or point out that you can get your survivor benefit at 60, whereas your individual benefit you can't get until 62. So you must be at least 60 to get a reduced benefit and 50 if you're disabled. The benefit is not available if surviving spouse remarries before the age of 60. So again, something to keep into consideration when you're looking at getting remarried. And divorced spouse can claim survivor benefit on ex-spouse's record if marriage lasted 10 years. Now, one bullet here that I want to highlight, and this is why it's bold here, is that this is very important to note because it can be a little bit confusing. If you take your survivor benefit early, it diminishes your survivor benefit, but it does not affect your own individual benefit. So the bullet here says claiming survivor benefit before full retirement age does not diminish your individual benefit and vice versa. So an illustration here that I'll give you a quick example is that let's say you have a significant working history. You're an executive, you maxed out Social Security your entire life. You can start taking your survivor benefit at age 60. You can take your survivor benefit at age 60, let your benefit continue to grow all the way till age 70, and then switch to your individual benefit. Now, another option there, less prevalent, would be taking your individual benefit. Let's say your much older deceased spouse maximized their benefit, right? Let's say they waited till 70, they maximized their benefit, and then they predeceased you. You could actually take your individual benefit at 62. You could take your individual benefit at 62, wait until full retirement age, because your survivor benefit doesn't grow past full retirement age. That's when it maxes out, just like your spousal benefit. So you wait till your full retirement age and you switch to your survivor benefit. So a couple of advanced strategies there to consider when you're thinking about when to take Social Security, both spousal, individual, or survivor benefit. So a couple different pieces of information, and this is getting into some more of the advanced knowledge. How late can you file? So you must file at your 70th birthday plus 6 months. Now I say plus 6 months because Social Security Administration will write you a single check retroactively for 6 months for the benefits that you missed. However, if you wait past that 6-month mark, you're just giving up benefits. So, oftentimes I'll meet people that have not filed for Social Security yet, and they say they're going to do it when they get around to it, right? They just haven't gotten around to it yet. Well, if you're past 70 years old in 6 months, you're just giving up benefit. You're letting the government keep that money. So it's important that you file at your 70th birthday and no later than 70th birthday plus 6 months. Now, that 6-month retroactive payment is something to keep into consideration no matter when you file, because this can slip people up. Oftentimes, the Social Security rep that you speak to may ask you, let's say you file 6 months after your full retirement age, just because that's when you retired. You file 6 months or a year after your full retirement age, they may ask you, do you want a retroactive payment for the last 6 months? The answer should be no in that case if you're filing before age 70, because what that will do is it'll reset your age of filing to 6 months earlier. So sure, you get a big check, but you forego those delayed retirement credits for that 6-month period. So sometimes they're not trying to trip you up. They're not trying to trick you. Sometimes they just don't know and they think they're doing you a favor. So something to keep in mind when you're having those conversations with the Social Security rep and you're filing for Social Security. What if I filed, but I changed my mind? So this is a question that I recently got from a CPA actually, who had a client that filed, but then realized that they weren't getting any benefit because they were still working. So you may withdraw your application. So there's two options here. You can withdraw or suspend. You may withdraw your application for Social Security if it's been less than 12 months since your benefit had been approved. Now, if you withdraw your application, you have to pay back everything that you've received so far. So if you've collected 11 months worth of benefit, you have to write a check back to the Social Security Administration for that 11 months worth of income. Now, if you do that, your delayed retirement credits, let's say you filed it at let's say you filed at 67 and then 11 months later you say, you know what, I changed my mind. I want to pay it all back. You get your delayed retirement credits for that 11 months because you paid it back. It's as if you never filed. Now, the other option is that you can suspend. What if you waited past that 1 year mark and withdrawing your application is no longer an option to you? You can suspend your benefit. Now, if you suspend your benefit, you don't have to pay anything back. You don't get the delayed retirement credits back for the amount of time that you've already received checks, but you will get delayed retirement credits from the time you suspend until the time that you refile. So two options if you filed, but you've changed your mind, to take into consideration. Basic tax consideration. So this is a question we often get for people that haven't filed yet is, okay, I pay into Social Security. Do they also tax me on Social Security? I put in this text here because this is actually off of the Social Security website. And I've highlighted only because I think it's humorous that the Social Security Administration says you will only be taxed on 85% of your Social Security benefits if you have income over $44,000. So only 85% of your Social Security benefit would be taxed. So for instance, if you have $100,000 worth of Social Security benefit between you and your spouse, and you have income over $44,000, $85,000 of that $100,000 would be considered taxable income. So that's how that works. And then there's some other amounts listed here. So another piece of advanced knowledge that I wanted to put in here that is not so much in terms of Social Security, but Medicare payments are taken out of your Social Security if you file for Medicare. So it's important to remember and to note, especially for people that are early in their retirement years, that if you filed for Social Security and you notice that your benefit is significantly diminished, you'll probably notice this earlier when you get that statement from Medicare saying, here's your cost of Medicare in for the next 12 months. There's something called IRMA, which is an income-related monthly adjustment amount. So if you make too much, they actually charge you more for your Medicare. That amount is taken out of your Social Security payment. Now, if you just retired, you might have a high IRMA or higher cost of Medicare. The IRMA is calculated based on your income 2 years prior. So there's a 2-year look back for your Medicare cost or your IRMA. So if you retired at 67, they're going to be looking at your 2 years back. And what you can do is that you can actually appeal your IRMA. So you can appeal. There's 7 qualifying events to file for an appeal. One is death of a spouse, one is marriage, divorce, loss of a pension, and loss of income from income producing property. But the 2 that I have highlighted here and most relevant to our conversation here today around retirement and Social Security is work reduction or work stoppage. So if you've stopped working altogether, you can actually, I've had clients that had to get a letter from their previous employer saying that this individual no longer works here. There's different types of proof that you may have to come up with. And sometimes it may just be your tax return. It depends on how easy it is to prove that your income is going to be different going forward. But something to take into consideration, I just had a client file for an appeal and save $10,000 a year on their IRMAA expense. I've also had a client that filed for an appeal because they sold a stock. In this case, their CPA filed the appeal for them. So I'm not sure which actual qualifying event they filed it under, but they had a large liquidity event. They sold a stock, and they were able to file for an appeal to lower the increased IRMAA from that event. So a number of different things to consider and also to talk to your CPA about or your financial advisor. So what have we learned today? Social Security and what it means to you, a lot of the common questions and strategies, both basic and advanced, and some ways to optimize your benefit. So that will conclude our presentation for today. If you have any questions, again, if you're a client of Paces Ferry Wealth, please feel free to call anytime or talk to your advisor. If you are not working with Paces Ferry Wealth, feel free to click on the links that pop up from time to time during this presentation, and we'll pop one up right now. And also you'll be redirected to a page that will allow you to schedule a meeting with an advisor after this presentation. So that will conclude our presentation for today. Thank you very much for your time.